because there's really never been a better time to invest.
So number one, you have to consider the micro markets. Boston is not just Boston.
Where do you see the trend going? Is this hot market something that can be sustainable?
Nothing is sustainable forever.
If there's 10 other people that are willing to pay that price, you're paying the market value.
What is a hotter trend, the real estate market or pickleball?
Over time, you're not buying either one for a short-term play, unless you're selling, puts and calls.
Where's the stock market going?
I love the frame of comparing real estate to the stock market.
So a couple moving from Boston,
Yep.
2 kids, can afford 20% down on a $1.5 million place, they've been approved.
Yeah.
What town are you showing them first
Yeah.
and why?
So 2020 was the year of the pandemic and the year of the shutdown. Throughout the year, we were talking different themes and trying to project what we thought 2021 was going to be. And unanimously, everyone agreed that it was going to be the year of the recovery and the year of pent-up demand, where we started doing all the things. And the conversations were, what are you going to do when whatever things are back to normal? Halfway through the year, it's turning out that 2021 is actually the year of FOMO, fear of missing out. I think back to Christmas time, my oldest son, Finn, who's huge into sports now. It's his passion. He just loves it. And we got into my old trading cards, my old football cards, baseball cards and whatnot. And, so he asked Santa Claus for some of his favorite players. And, the fear of missing out trickled down to things as silly as sports cards. There's a big uprush in demand for old sports cards and rookie cards and new ones and whatnot. And I couldn't find a reasonable price on any packs. Anyway, very hard to get. So fear of missing out for even Santa Claus couldn't get trading cards in December. Fast forward to January. Every single news headline, article, post, storyline was about cryptocurrencies. How high can they go? What stores are taking them now? Can you buy a Tesla using Bitcoin? So it was the, all-time highs, and people were having fear of missing out for that. What if I don't get some? How high can this go? Followed by Reddit stock picks, the meme stocks going through the roof as well. People asking, hey, should I just get a couple shares of these stocks? What if they keep on going like this? Then followed that by one of the biggest ones was real estate. I personally am feeling FOMO because my real estate game plan was to be in my current place for 5 years, and I'm on year 4 of it. We were thinking about sitting down and shopping for a larger place next year. But it's come up between my wife and I a dozen times over the past 3 months is, hey, so-and-so just bought a house for that, or the house down the road went for this, So we're starting to get a little bit of FOMO as well, and we're starting to get these questions internally. I'm getting these questions from my clients all the time about what the plan was, and whether they should downsize now, and how long this can last. Is the inflation transitory? Is a term that you might have heard, or has this been ratcheted up? So while I understand the real estate market, I am by no means an expert, and I have the same questions as you. So I've lined up some top people in the industry, people I've run across, and people I really trust. So today, instead of me just sharing my own anecdotal thoughts on real estate, we're going to get the experts to weigh in on this. And for this casual conversation, I probably will tell you some of my anecdotes about my real estate journey. So typically, this time of year, real estate slows down. It heats up in the spring and cools down in the summer. Now in the Boston area, if you're from around here, you'll know that September 1st is a key real estate date. That's called moving day in Boston. And if you live in Boston already, you try and get out of town because all the leases on the rentals turn over, and the moving day is September 1st. So people are, the city is overrun with moving trucks of people coming and going. And then if you're going from renting to buying, your lease ends and you're doing that journey as well. Typically, you can't find parking, and every year Sturo Drive is the main way to get into town, and it's no trucks allowed because there's some overpasses that are too short. So each year there's a couple of people who aren't from the area who fly down Sturo Drive and get their truck stuck and cause a huge mess. So anyway, anyone who plans the end of the summer vacation tries to make sure they're out of town for September 1st. As far as real estate and the economy goes, true wealth is built in several different ways, but you'll hear a lot of people say true wealth is built through real estate. And that's because people climb the ladder and they do it with a plan, hopefully. Sometimes true wealth is built, but sometimes true wealth can be lost by making a mistake in real estate. You think about why gains are so much. It's because of the leverage people use. You typically go and buy a stock, $1,000 stock with only $200, where you might buy $1 million residence with $200,000 down. So you're owning 20%, 100% of the gains and losses, but you're only putting 20% into it. So let's go with that example. If you have $1 million property and it's $200,000 down payment, and the real estate market fluctuates by 5%. If it goes down 5%, you just lost $50,000 on your $200,000 investment. On the flip side, what if it continues to go up? What if over the next 5 years, you have a 5-year holding plan and the market goes up by an average of 5% a year? Compounded, you didn't make 5% times 5, 25% gains. 5% gain on $1 million per year will actually make that downtown condo or that house a $1.27 million value. Now, additionally, if you've been mortgage and paying down the principal on your mortgage, that $800,000 mortgage, the balance of it could be roughly $690,000. So now with your $200,000 initial investment, you would only owe roughly $700,000, and then the property would be worth $1.27 million. So you have over half $500,000 in equity from your $200,000 investment. Now, these are just broad stroke assumptions, and I'm not projecting and I'm not making predictions. I'll leave that to the realtors where they think things are going. But I'm just using this example. Over the past 12 years, we've seen prices in real estate in the downtown area, even though and more in the suburbs, go up more than 5% per year. So, as you're taking a look at some of the listings, you see $2.5 million house or $2.5 million brownstone downstairs. And my wife and I have looked at each other and said, who in the world in their 30s and early 40s can afford a $2.5 million place? Well, it's because they got in, their equity's grown, so their down payment's now compounded. So that same $500,000 is 20% of a $2.5 million condo or house. So, you've climbed the ladder, and the typical real estate journey is you might rent for a couple of years downtown until you get 10 or 20% down. You buy a studio or 1 bedroom. Then when you get married, you might buy a bigger place together by combining your assets. And then as you have kids, you make the choice whether you want to play the downtown school lotto or you move to a place with great schools. So that's the typical real estate journey. So today I've lined up, like I said, a few different realtors and a mortgage broker to talk about some different strategies. First up is Mary Gillach. She's recognized as a leader in Boston area real estate, ranking among the area's top agents since 2003, which is kind of a funny number because I think I met her in around 2004 when my wife Jen was in law school. She lived on University Road in Brookline, and at that point, it was more window shopping than anything. But Mary lived around the corner from us, and we ran into her a few different. We'd go to brunch and we'd look at some different condos in Brookline, just kind of think about what our next step would be. My relationship with Mary's gone back almost 2 decades at this point, and she has 15 years. Previous to this, 15 years of experience in healthcare management, and she has her MBA from Wharton School at UPenn. She knows the local area extremely well. She's raised kids in the Brookline area. She understands the importance of, balancing the family needs. She works well with people who are concerned about, which is more important, the yard or the school system, the space, and whatnot. So while she's an expert on those towns I listed, she's also an expert downtown because a lot of her people are moving from downtown. So she has to be on top of all those markets. I know I always appreciated her tagline. I've heard her say, and people say about her, expect more and get it. So without further ado, let's have a conversation with Mary. What is a hotter trend, the real estate market or pickleball?
That is a toss up, complete toss up.
Mm.
And it's all anybody's talking about is the two things too. So it's like,
I mean, I've
really
between,
crazy.
I mean, I between you, a couple of my colleagues, my last vacation we were on, there's pickleball court. I mean, I'm seeing it everywhere, and
Unbelievable.
it's incredible. So anyway, yeah, I love that idea, and I'm gonna have to check that out because we did for my kids do a tennis clinic, a family tennis clinic that we just signed up for this summer, and I haven't picked up a racket since, I mean, 20 years, and I just
Right.
loved it. I just loved hitting that ball, and it was like,
Yeah.
and I want to play against some other than 8-year-old, so maybe I can join an adult pickleball tournament and get that fixed. So
Well, there's a bunch of pickleball players who used to be tennis players like me who said, I'm never playing pickleball until I can't walk,
yeah,
or like, I'm not going to play golf until I can't run anymore. But you play it once and you will love it,
okay.
especially if you're a tennis player.
I'll
So,
have to look in my local town to find it. So, all right, great. And all right, so just to tie it back to the real estate theme that we have going on this month. In my business, whenever I get the question all the time, where's the stock market going? And the answer I give them invariably is, I can't make the short-term predictions, but I know that if you have a 3 to 5 year time frame and you do your research, I feel comfortable making that advice. So to flip it back on you, the parallels between the real estate market and the stock market is they've been both extremely hot for over a decade now. They've got a couple little blips here and there, but like, where do you see the trend going? Is this hot market something that can be sustainable?
nothing is sustainable forever. We think about the real estate market going in 4 to 5 year cycles, not 12-year cycles. We've seen a 12-year run up, and it's been very consistent, since 2008. So we're moving on to that 12 years, 11 years, yes. But it's been a very consistent run up. This last year with COVID, things went off the rails in two directions though. And people don't talk about that. It's like, oh, the Boston real estate market is up, 15% over the last year. Well, but that doesn't mean every market. So number one, you have to consider the micro markets. Boston is not just Boston, whole Boston area. The suburbs went crazy. Boston downtown couldn't give something away. So you have to think about that. But in the overall scheme of things, real estate as an asset class has done the same thing as the stock market. Over time, you're not buying either one for a short-term play. You just, unless you're selling, puts and calls, but you're buying a house, it's an asset, it's got pretty big transaction costs. You're in it, you're going to stay for a while. If you're not going to stay someplace 3 to 5 years, I'm saying even 4 to 5 years for real estate right now, because transaction costs are so high and because there's volatility. But if you are going to be in there 4 to 5 years, it beats rent, hands down. You're basically saving a portion of your monthly payment is a savings account. It's principal, which people don't realize either. So I think over time, it's going to act a lot like the stock market does. And the thing that's made it more like the stock market actually is it's become, I always thought of it as an illiquid class. It takes you 6-8 months to think about things, and then another year to decide to do something, and then they're moving. And the pandemic proved that that's not categorically true. I was shocked the speed with which people made decisions. Within 3 months, people changed their entire life and their family's lives.
One thing I want to interject is, a recent phenomenon with, Zillow and Redfin and whatnot is people can price their house daily or think they're pricing their house daily. Where in the past it was, the real estate market fluctuates and it was just the thing that you live in. It was your house, and you didn't really think of it as a fluctuating asset. And now I can go on Zillow and see what my house did in the last 12 days or, 2 days, and it affects psyche.
Yeah, it does get into people's psychics. They know it's exactly what's going on at that moment. And it makes it feel more like a stock because you can get daily information, you get minutely information. If you look at how those algorithms work, you will decide to change your mind. However, like they don't know. I priced my own house on University Road years ago, I think where I met you. Yep. And people would walk in that door and they'd say, wait a minute, Zillow says it's worth $850. I said, right, because my neighbor was the only tax taken in all of Brookline ever. And that's their number one driver. My house is worth $1.3 million.
Yep.
So good realtors will actually play that. So if I'm coming in at a market price, but Zillow's off the rails high for whatever reason, and there's a lot of reasons, I'm like, hey, motivated seller.
Yep.
So you get played with that kind of stuff too. What you need to look at is really, what is the underlying asset really worth? And that's what we look at. But to go back to your question about, is this trend going to continue? Two things are, the macroeconomics say yes, especially in Boston. We have got an attractive place to live. The last couple of governors have been doing, kind of corporate friendly moves and bringing in a lot of businesses that require high level skilled workers. And that's who we have here. We got the MITs, Harvards of the world that want to stay here. And so we don't have enough real estate. We don't have any land. So we've got a fixed pie close to Boston, like really close to Boston, and a ton of demand to be there. So I think over time, we're going to be fine in the Boston area. I do think, though, across the country, as interest rates go up, because what's been happening is interest rates are going lower, prices are going astronomically higher compared to history, annual rates are going way up. At some point, we're going to have this confluence where this stops going up, but this starts going up. And so you got a seller who says, my house is worth $1.5 million because my neighbor just sold for that. And you got Mr. Buyer who's saying, yeah, but that was a whole percent ago when I can afford that. And now my money buys me $1.3 million place. And so the two of them will standoff until someone gives.
Right.
And that'll be hard, I think, for people.
I mean, it's always, anything in economics always comes back to supply and demand. And right now, not just right now, for many, many years, the demand's been through the roof. And really depends on the seller. What are the sellers willing to hold? Are they willing to sell? And if there's no supply, then the demand has been. So I'm noticing this same in a lot of parts of the stock market, and the real estate market is obviously the same. So please remind us what happened during the financial crisis, the 07, 08 financial crisis.
Yeah.
And how is this different?
That was brutal. That was like an overnight event. It was a real one-off. It was a collapse, not of the market, but of financing, right? All the banks were doing goofy things and they just weren't being the oversight was not there. And so that really stopped people in their tracks because they literally couldn't get loans because the government was like shutting stuff down. I mean, remember when Fannie Mae and Freddie Mac shut down for a period of time? It's like, that is like unheard of. That is the mortgage funding source for most of America, right? They shut them down, then all of a sudden, okay, we'll open up the smaller loans, but we're not going to do jumbos for a while. It really shut off access to money. And that was a different story. Normally what you're seeing is not that. You're usually seeing the supply and demand issue, and we weren't seeing that with that crisis. It wasn't a rate raise increase. Well, it was a rate raise for a while. And that stopped people buying too. But you just couldn't get a hold of money. That's fundamentally different than what's happening now.
Okay. Right. Appreciate that. I mean, there's a question that, like, when I talk to people about whether it's a bubble or not, and they talk about what the prices did in 07, and, like you said, it's fundamentally different. And, I think that's a great way to put it. One thing that, since that,
a little bit of a bubble though, Scott, is it could be a little bit of a bubble that people moved to places to get away from the city and to live. Totally understandable. But those places weren't worth what they're paying for them now, or they've never have been. And kind of dramatically overpaying for what they're getting relative to what the market's worth there. And if and when things change with the pandemic, and I should have qualified that like I did before, anything I say today has to be qualified in the light of, if we all get shut down again for another 6 months, bets are off, because people might really decide they are staying on the Cape and working from there for the rest of their life. Yeah. Whereas, I think everybody's assumed it's a short-term play and everyone's going back downtown Boston. So it all depends on what happens with the pandemic, but that could be a little bubbly depending what happens.
So, I mean, along those lines, a lot of the things that we're talking about in the financial side is, transitory inflation. Is some of these things short-term? Are they just based on the data we're looking at right now? And there's a clear path to where it's going to go back to where it was. In the real estate market, it feels to me like this was almost a ratchet up. But now you can't talk macro, so maybe you can talk about your experience and whether you would agree with that, or whether is this some of the thing where I think prices are up and then they might flatten, or is this more of a transitory?
Well, they've got to flatten at some point. I've talked about this. You just don't have this kind of dramatically long run with nothing at the end of that run. It's either going to be a tail off or it's going to be a downturn. I don't think we're going to have a major blow up here in Boston. We just have such constrained supply. And it's not a matter of builders not having the money or having the want and desire to build. There's no land. Right. So as long as the kind of an economic situation and the attractiveness of Boston stays here, the big colleges stay here, that's not going anytime soon. Policy making it easy for corporations to be, that's not going away anytime soon. So I don't see it changing over the long term.
Yeah,
not definitely in my lifetime.
I mean, the work from home movement, I think, is going to hurt commercial real estate more than the residential real estate. Dramatically. I know that part of my financial plan is my wife and I, we want to move back to downtown Boston once the kids are grown. And, when I lived in Beacon Hill, you know, fastest growing population there was people from Wellesley selling their humongous houses with the yards and buying a brownstone up in Beacon Hill. So, that probably slowed down in the past year, but whatever this is back to normal, I could see the demand. And even if you don't have to work downtown, there's a lot of amenities and a lot of reasons why it's one of the top places to retire.
Yeah, I think as long as those amenities exist.
Okay.
There's some talk about, all these restaurants have closed. Who's going to be starting them back up again? Who's got the capital and the guts to do it, given there's so much uncertainty that how long we're going to be living with this, which may be indefinitely to some degree. So do things spread out? I was talking to a restaurant owner yesterday. I said, I love your parking lot. It's an awesome place to have breakfast. They had these beautiful things set up. I said, how long is this going to last? He said, I don't know. They're kind of cracking down and trying to get us back inside.
Yeah.
I'm like, why? So if things do change, the attractiveness of the suburbs also are going to be more than downtown, because people go downtown a lot either to retire and to be able to walk to theater, walk to restaurants, walk to the river. But a lot of people go downtown also because they just want to walk to work.
Yeah.
If they're not going to work, they can take the train in for a theater once every 3 months, So I'm interested to see how that all works out. But in general, that's where we're expecting it to go, is back to normal. And it's started to eke back that way. So
that's great news to hear. Are there any markets that you represent that you feel still have some value or some room to run that people should consider?
Yeah. So some markets I do and some markets I don't represent, but I'm buying in myself. So one place is, I'm just surprised to say this, but Back Bay and Brookline condos. And single family homes downtown too, there's just not many of them, but Back Bay and South End they just took a big dip last year, big. Back Bay was 18% down, and that's starting to come back. But if ever there was an arbitrage situation for somebody like now, sell your big Wellesley house, sell your big Brookline house, buy downtown, stay at your Cape House for a year if you need to, because those people have that kind of wealth very often. And then you got your place for 18% discount. It's the only arbitrage I've really seen in real estate for a while, unless you were moving to Oklahoma from Boston.
Okay. Well, I know when, fast rewind many years ago when we first came to Boston and Jen was in law school in Brooklyn. That's where we met, is when she lived right down the road from you. Back then people were telling us Southie, is where to go. And then the next one is when we were moving to Beacon Hill, the people were talking about East Boston, so there's different areas where that was on the top of people's tongues where we didn't necessarily want to live there at that point, but there was the light at the end of the tunnel saying, hey, 10 years from now, you're going to be excited about the prices you got in at. And, once they put a Whole Foods in Southie and East Boston, then, that's the Whole Foods index metric. So
those two have just blown the tops off, in the last 5 years. So those are no longer bargains. Malden, we've been selling a lot in Malden, believe it or not. There's some great stuff in Malden. It's cheap. You can buy a single family home for $800,000, which is very cheap by my market standards. Downtown and Brookline, you can't touch a house or even a 2-bedroom condo for that. But in Malden, you can get a great little, Craftsman or something. What's going to be a really great one, I think, and is starting to get some attention, is Worcester. It is just not that far away now with the rail. And now they've got, some pro or semi-pro sports out there. The industry's moving out there. It's cheap, great quality of life. They've got good schools. A number of people I've known that I would never thought would leave Boston have gone there. So I think that's especially for investors. You can get a 2-family home for $400,000.
Wow.
Wow.
Something to consider. So there's definitely some value a little bit further out. So, I know when part of my real estate journey, we were looking heavily in 2013 through 15 when my son was little, and we ran into what the whole country is experiencing right now. We ran into a lot of, we saw something online. We loved it. It was listed. We went there for the open house. We wanted to make an offer on Monday, and we were outbid by, $100,000 regularly. And either whether it's cash or whatnot. So are you still seeing that? Or has it picked up since then? Is there any kind of hope you can give someone who's perhaps looking at, not necessarily coming in with $1 million bag of cash?
Yeah, we work with a lot of people like that have the means. I mean, most people not getting their offers accepted have the means.
Mhm.
They have their pre-approval. It says 9 times out of 10, they're going to get their loan. But that 1 time out of 10, the seller's just going to say, I want to avoid that. You know, who wouldn't want to avoid that? You're doing your planning based on the offer, you get accepted. But the other thing is that, you know, what sellers want is no risk. You know, what sellers want is way over what they're asking for, closing the day they want to close, no inspection, cash, no risk after they get their initial deposit in the bank. And most of us can't afford to do that. You know, we just don't have that kind of cash in the bank.
Yep.
But there, you know, if you go to a good lender, you know, I always advise people these days, work with banks. I'll get me in trouble with mortgage brokers, but the banks can get this stuff done because many of them hold their own loans and they can do what they want. They can do 10% down instead of 20. And we're seeing a lot of that. But the biggest thing is that you need to get yourself, if you don't have the cash, get yourself an underwriting approval right up front, not a pre-approval, but an underwriting approval. What that is instead of providing all your documentation after you get your offer accepted to get your loan and then having that 3 weeks to evaluate whether you get the loan or not and maybe giving you a loan, they do it ahead of time.
Yep.
So you can get the bank to say, you have got this loan. It's subject to an appraisal in most cases, unless you have a lot of cash down, but why not do that? It gives the seller something they want, costs you nothing. And the problem is that people won't accept your offer if there's a contingency. So you might be good for it all day, but they don't want to take that chance. Just do it up front. And that doesn't cost you anything to do.
I'm definitely finding a lot of my clients are in the boat where if you're not coming from saving up your down payment and coming in like that, a lot of people, they have more than the 20% down payment. Now they might not have the all cash offer, but you know, just because of the leverage of buying a property that increased. And then, like I said, the savings account of buying down, you know, just if they bought like a $750,000 condo and the market did over 5% over the past 5 years, you've actually compounded. It's not a 5% return on your money. It's more like a 25% return on your money because of the leverage you use. So you might have came into that condo with 10% down and you're going to leave it with, you know, 30, 40% down on $1.5 million place. So just based on the power of the compounding.
Yeah, you got it. So that's where people really, I think, get derailed with real estate is saying, I'm not going to make my first purchase. I'm so you know, conservative. I want to wait until I'm at 20 or 30% down. Give me another year or two to make more money. I know my salary is going to go up.
Yep.
Your salary is not going to go up at the same rate the market is, because the market is based, if it goes up 5%, it's not 5% of your 10%.
Yep.
So if you're buying $1 million place and you put $100,000 down, it's going up on the base of $1 million. It's not going up on a base of 10. So you never catch up if you play that game, unless you've got big bonuses if you're in finance or something. So I always encourage people, get in when you can, because you're leveraging, you know, an asset that you're not fully invested in. The bank is helping you invest.
Yep. Awesome.
That makes sense.
And the last question, you know, I really have is, someone was asking me, and we were kind of intrigued by this, about AI taking over parts of the real estate market, and how have the Zillows and the Redfins of the world affected your job?
Ooh, those are two different questions, actually.
Okay.
AI is a whole different thing than what the Zillow, what they've done to the real estate business.
Yeah.
But I'll start with the AI. They're doing some of that. It hasn't worked particularly well in how they're managing inquiries and handing out leads. It seems for a lot of people, number one, they don't get the right person. They get somebody who doesn't call them back. You know, the whole AI thing, trying to direct to the right person and answer your questions. Real estate's a very personal thing. And I used to say personal schmersonal. I was a management consultant and I restructured businesses to take out the fat and to, you know, reorganize processes. I just don't see it with real estate. You have got to have, at the end of the day, maybe something on the front end, more like insurance. You can definitely do with that. Go down the decision tree of AI and they'll get you to the right person, get you the right information. Very hard on real estate, because you got to have somebody, number one, who knows the market intimately. Yeah, that's a busy street. You don't want to waste your time going to see that. Oh, that school is going to be renovated in 2 years. Your kids will be blessed for 2 years. No site's going to have all this information of what people want. And even more than that is people come in, they don't necessarily know the even right questions to determine what they want. I'll start with someone who comes in and says, yep, I want a 2-bedroom, 1-bath with parking in Brookline. I'm like, okay, that's great. Let's see what we got. Okay, so what kind of parking? Oh, well, I have to own it. I can't rent it. Okay, that's off the table. You have to own it. Oh, it has to be a garage. Oh, that's off the table. And even though it shows on those sites as a garage, it's not. You have to look in the broker notes to find out it's rented and it's 4 blocks away. So you're never going to get the level of information you need to get to help somebody with AI, because they're not going to ask those questions. They also aren't going to know the market. So sounds a little self-serving because I am a realtor, but I will say when I first got into this, I did not get into it for a long-term career. I got into it because I didn't feel that there was value in the broker I'd used before. And I had 2 years from having a baby, and I'm like, I'm going to learn how to be a realtor and do this myself because I didn't see a lot of value there. And the minute I got in, I'm like, oh my gosh, there's tons of places to add value here. And so I just don't see AI is going to do it. The other question is how is Zillow and Realtor and all those guys affected the market? Well, tons of ways. One biggest way is what you mentioned earlier, the Zestimate, the dreaded Zestimate. People look at that and they say, that's an independent third-party evaluation of what this property's worth. Mary, your pricing's wrong. You're just going to gouge me because you're the listing agent. Or if I'm a buyer agent, I'm saying, guys, ignore that because, I sold the place to the guy that wrote the algorithm for Zillow. Yep. I know what it is. I don't know what's going on there. It is not a good evaluation of your home. So it gives people empowerment, but not the right data. It's dramatically off in this market. We don't have any widgets here. Well, I guess downtown you do, but you got a couple of high rises, but the street, the location, the condition, the light, the school system associated with it, the parking is real or not, you're never going to be able to get that.
So anyway, basically the human touch to it. I mean, I definitely see that as, I might probably fumble this, but I've used the example of a Peloton versus a stationary bike versus a personal trainer where, a realtor and Zillow and all these different things, they can work in conjunction and you can maximize, all the different efforts where, if you're a stationary bike, it might be something that I'm about to get baby bomb. So you might hear that in the background. But the stationary bike, if you don't have like the expertise that goes along with it, you're just going to have something that you're not using properly and you give up on. Or if you end up using the Peloton, it is a curated class that knows you, gets to know you, and like coordinates the stuff. So let's have some fun with the last question. Let's pretend I have a client who's moving to the area, $1.5 million pre-approved for $1.5 million house with enough money down that it's not an issue. Two kids. Obviously, school is important. What neighborhood would you say they should start their search in?
1.5 million, 2 kids, and they want good schools. And they work in Boston?
Yep. Relocated to Boston.
Your very number one spot that people go to with that scenario is Brookline. It's the closest town with a good school system, perceived safety, because I can never guarantee safety, easy transportation, an amazing community like you have downtown. You see everybody at the park. You don't all have big backyards. You get to know people. Yeah. But it's proximity and education. And then it's Newton and or Milton and or Winchester. Those are all the kind of closest in. Lexington's more of a haul. But the Wellesleys, the Needhams, those, some people go directly from downtown to those or even to a Newton, but most don't. I find most people I work with coming from downtown, and that's who most young 2-kid families are. They're coming from downtown, they're coming from a Boston neighborhood, they're coming from Cambridge, coming from New York, whatever. And they're going, I don't want to give up my Starbucks walk. I don't want to give up crawling to the grocery. And I don't want a big backyard to take care of. Oh my gosh, my kid's only 6 months. So they come to Brookline and then they say at about 7, 8 years old, the kids, I need a yard. They have to get out of this house. Then we're moving to a little bit further out ring of cities.
You just described my journey 100%, and we tried the Brookline one, but in 2014-15, I was too conservative and I couldn't pull the trigger on going $150,000 over asking price on some of these places that I still look at, I still have saved, and I still look back at it and say, oh no. But one thing I
want to say about that asking price though, Scott, and everyone needs to get this in their mind. That is just a made up number. It's somebody's either opinion of what it's worth or hope and dream of what they're going to get, or they're using this estimate and they're undercharging by 150 grand. It has nothing to do with what the price is really, what the value of that house is really worth.
Yeah.
So get the asking, like if somebody was asking you 150 grand under which you knew that price was property is worth, you would have no problem paying 100 grand over ask, would you?
No,
no. But if it's 100 grand over what the value already is, you're definitely not going to pay 100 grand over. How do you know what that value is?
Yeah. An expert. someone sees and does it every day and sees what the offers are on the other side, and has experience in saying, I'm all for having expert advice on such a thing, because it's you don't know what you don't know. And I mean, I just had an interaction with my accountant a few months ago that really just, I felt like I could do my own taxes for many years, and I was wondering, why am I doing this? And then after the last year, with all the rules changing, last thing I wanted to do was stay up at night and figure out what COVID did to my taxes. And I would have missed things that would have cost my family $10,000 plus in tax credits. And I mean, just that's the sort of thing, you don't know what you don't know. And then you don't know the inside and outs of the real estate market, and you don't know the inside and outs of the tax code. And paying that accountant $1,000 to do my not very complicated taxes, I just prepaid the next 10 years worth of his services, just by one thing I would have missed.
Exactly. And your time. I feel that way about all the professions, but you grow into that as you grow older too, right? What's my time worth? And, where can I get that savings? Exactly what you said. So.
Awesome. Well, I appreciate your time so much, Mary. We'll definitely be in touch, and thank you so much.
All right. Thanks, Scott.
All right, have a great day. My next guest on this real estate journey we're on is Matthew Blanchette of Blanchette Homes New Report.
Hey, everybody.
This is awesome. I was going to do this over Zoom, and he offered to use his beautiful backyard, and to be able to do something in person after the past year and a half we've had, I really appreciate opening this up to us. So I know Matt through my real estate journey, and as I came to New Report, he was one of the first people I met through the New Report Dads Club. Kind of neat.
They've loosened up the terms of being a dad.
Yeah. So, I mean, just a little bit about my real estate journey. I did talk about it in the past, but, I'm not sure if you realize this, but the market that we're having here is what I was experiencing back in downtown Boston, 4 or 5 years ago.
Right.
And we were shopping, we were living in Beacon Hill, and we were shopping in Brookline and downtown. And without exaggeration, we got outbid by hundreds of thousands of dollars, multiple, high single digits at times, my wife and I did. And, we thought we were chasing the dream of, living life on the hardest level, but enjoying everything about it.
Yeah.
And 2017, we got outbid on one that we still look back at and we say, hey, maybe we should have just done that one. But the following weekend, we were down in Delaware. My wife's family has a place in Delaware. Her an aunt and two of her uncles have places. They open it up every Memorial Day. Mm-hmm. So at that time, Finn, who's my oldest, he was 3.5, and we had a 1.5-year-old. And he's been paraded around the city. And you don't know what a 3-year-old understands, but he apparently got it. So we pulled up to the beach, and he said, "Dad, let's buy that one." He pointed to a house, 200 yards from the beach. And I was like, "What are you talking about, buddy?" And he says, let's just, let's buy that one. I'm like, "Well, what do you get?" Like, why? He's like, "Well, I like the beach." Well, what about the Boston Shore Museum? What about the Esplanade? What about your preschool we're spending all this money on? What about all these awesome things that we thought we were living in Boston for? He liked the beach better. So, long story short,
from the mouth of babes.
Yeah, couple weekends later, we were up at Appleton Farm doing a Father's Day event. Yeah. And he fell asleep in the car. We went to an open house in New Report, and
found the beach.
So that's we found the beach, and so we thought we were chasing something downtown, but we found our family. This was our spot. And anyway, so that's my real estate journey, and that's what brought me to New Report.
Glad you're here.
Yeah. So a little bit about you. You have a history of different industries, but this is your 4th year in real estate. Something about 75 deals going to close.
Yeah, we're on track to total of 75, and it's our 4th year. And you mentioned the many industries. So I was a general contractor for 20 years, and I was a teacher for 5 years. Okay. And I was talking with a friend of mine the other day who's known me the entire time, and he said, "Matt, it seems like you're finally just getting paid to be yourself." I think it's a great way to look at it. I see the many roads converging, and it gets me. My teaching side helps me to communicate clearly and make sure that I'm educating properly, which is a lot of what this job is, like we're doing here today. And then from a GC perspective, really helps me to analyze a house and understand what's happening and be able to, be a coach or help my client understand what they're looking at. So
That's awesome. And you
Yeah.
know, I know you specialize in antique homes, and
Yep.
he actually plays old school baseball.
Yeah, I've been
Classic
playing
baseball.
vintage baseball at the Essex Baseball Organization. Shout out to Historic New England at the Spencer Pierce Little Farm for, gosh, this is my 5th year there. Having a ball. Just played 2 games on Sunday, lost both, but we had a blast.
Awesome. And you know, one other thing about you, this is gonna be the 2nd year of the Turkey Classic.
Oh, thanks for bringing that up. Yeah, so the Dad's Club actually started that. We've taken it in-house to the Knights of Columbus, but we raise money to feed local families, and our catchphrase is put a turkey on the table. We're trying to help people provide Thanksgiving dinners. So the Turkey Classic, I'm sure there will be a link on this. You can sign up for
Well,
it.
definitely, I'm you know, excited to be a sponsor and help volunteer on it. So you know,
Glad
I
to
think
have
it's an
you.
incredible cause, and I think it just speaks to, you know, your involvement in the community and whatnot. So now let's ask him some tough questions. All right,
sure.
so
Let's go. Let me roll
you know,
the sleeves up.
Yeah. So my, I mean, I get questions like this all the time. Being an
Yeah.
investment professional, like, you know, where do you think the stock market's going?
Yeah.
And you know, my thing is, I don't have a crystal ball. I don't know what the next move's going to be. But if you're going to do any type of investing, I say 3 to 5 years is a legitimate time.
Yeah.
And you know, so with that in mind, I mean, there's a lot of fear of missing out right now.
Yeah.
The market is so hot here.
Yeah.
And you know, there's a lot of people, myself included. I had a 5-year plan. I
Yeah.
had not planned on shopping. Over the past 3-4 months, the topic has invariably come up with my wife and my clients. And I'm to the point where it's like, do I have to get in now before prices keep on going up? Do I wait a little bit for things to pull back?
Yep.
So I'm asking to look in your crystal ball.
Yeah.
You know, what do you say?
Yeah. So you just brought up so many good points, and I don't want to miss any of them, so I'm taking a few notes. So first of all, I love the frame of comparing real estate to the stock market, because there's really never been a better time to invest. So what is scary, however, to a lot of buyers, understandably, is that they're just looking at the sheer logistics of, I'm not going to be competitive unless I'm 10+% over. And there's no way to sugarcoat that. Like that is the truth. But that's a common misconception of, you know, I'm paying over price. No, if there's 10 other people that are willing to pay that price, you're paying the market value. Now, the silver lining here, and what kind of helps my clients to, you know, see the big picture, is yes, there's going to be a one-time upfront cost where they are going to have to pay a substantial sum to buy a home. Once you're in, if you look at the rate of appreciation, okay, and we'll get to what drives that in a second, but you're looking at the fact that as soon as you buy that house, you're making money on your money. So the national interest rate is 3% right now, sub 3% if you have above 750. And if you're making, for example, from 2000, in the last 12 months, the average house in Newburyport has appreciated by 13%. So if you just look at those numbers alone, you're looking at the average person made 10% on the sale price of their property. You really quickly get to the point where you're making money off the bank's money. And that's not an investment you can make in the stock market. It's not as capricious as the stock market. You're paying yourself to live. And ultimately, it's been a really strong blue chip investment. And I know that you had mentioned earlier about you know, the big crash of 07, 08, and I alluded to it just now with, you know, what drives appreciation, and really the answer is absorption rate, and absorption rate is, for those of you at home, it's just basically how quickly are houses sold, or how long does the inventory last. So if there's 10 houses on the market, how quickly are they lasting? And the answer is obviously not long. And I know I'm not different than most realtors in this area. I have about 12 buyers for every one seller that we're working with within Blanchette Homes. So there's just more buyers than there is houses. And that's what's different between today and 2008. Because in 2008, we were driven by bad regulations. And I'm sorry to say it, but it was just people got loose and fast with lending cash, and you put people in a position where when the bank came to call, you know, if you've seen The Big Short out there, It's going to explain 07, 08 very well. And I think that the difference now is we just don't have the houses. It's strictly pure supply and demand economics 101. And that's the biggest difference. So where does that leave us? Well, we're with first-time home buyers who I can empathize with, people our age who've been scraping together enough money to buy their first home, and they're seeing the sheer logistics with no experience. How do you be competitive, right? And how do you avoid having to make 10 offers? And that's a real question. I think there's obviously a benefit in having a realtor that knows the market. But I think there's a lot of different ways that we can help you to be competitive in this market. And I'm just quickly, some of the things that we pride ourselves on is communication, not just with our client, but with other realtors as well. So that's going to mean that as soon as a house comes on the market, we're watching the market every day. When I'm on the listing side, an interesting number to find out would be how many times does the house sell to the first realtor that calls me? Because that's always my objective. I'm watching the market every day. I know if it's going to fit a client or not, and if it fits the criteria of a client, and it might be a winner, I'm calling that realtor immediately because I want to instill trust, and I want to let them know that I pay attention, I'm sharp, and we're going to close the deal. So almost more competitive than even being a cash buyer right now is, are you going to offer the best price, and are you going to close with a smooth transaction? There's 100 different things that can go wrong from the day you make the offer to the day you get the keys. And a good realtor will bulletproof that transaction every step of the way so that you instill a trust in the other side that we're going to get to the finish line.
There's a lot there. So let me ask you to go deeper on one little thing. Cash offers, and you said there's ways to get around it.
Yeah.
With this such a hot market, things are going above asking price.
Right.
So, I understand why cash is king, because you don't have to worry about a thing that's praising out. Have you had any experience recently where someone maybe comes in with 10 or 20% down and it doesn't appraise right?
So yes. So a few different things you just said there. So what they're really saying, what the seller is really saying when they say I want cash, they want a deal that's guaranteed to close. So one thing that people are doing is actually waiving appraisal contingencies, mortgage contingencies, or some variation within. Okay. Now, caveat here, I'm not saying anybody should do this, and every situation is different, and there's certainly risk involved, but there's different ways to become competitive in different situations. You can talk about restructuring a loan so that if you were going to take 20%, if you were going to put 20% down, you can guarantee that if the house doesn't appraise at value, you can still cover the difference. Okay. And that can be a way to help you, especially right now where PMI is next to it's lower than it's ever been. So a big reason some people put 20% down is because they can avoid that extra $100 a month, which is very nice. But if it's a difference between winning and losing, and you have to take 5% and put it down, chances are you can still pay off that 5% in the next year that you just borrowed from your 20% payment, and now in a year's time you no longer have PMI. You only had to pay a small amount of PMI in the meantime. So
awesome. Yeah, I mean, I definitely can see the value in having a plan in place, knowing what you can do, and having a backup. So waiving, I mean, basically in this environment, I saw, like I said, when I was in Boston and Brookline, where it was very hard when I wasn't able to take the risk because I knew how much I had to do.
Yeah. So in general, the three things that are going to make your offer the strongest are going to be pricing, timing, and condition. So obviously pricing, we're talking about not just how much you're willing to pay, but how qualified is your offer. Yep. Obviously cash is the most qualified if it's not contingent on any loans. But if you're a conventional loan and you're willing to work with the seller and give them some kind of a guarantee that you're going to be able to back up your offer, your 10, 12% over offer, and you're going to find a way to make good on that, then at the end of the day, what I'm finding is that sellers just want the highest and best offer.
Yeah.
So that's pricing. Timing is an interesting thing too. So we're seeing now sellers that are in the position of, well, okay, great. I just sold my house for 12% over, but now I need a place to go. So now they're buyers. So if buyers, and this is where the power dynamic starts to shift, and we're seeing buyers start to win, because the buyer that can be the most flexible on timing, it oftentimes can be more competitive than a cash offer that needs to close tomorrow.
Yeah, that's a good point.
So if you're a buyer and you can say, listen, you can rent back this house. I'm going to close so you have the cash.
Yeah.
And then I'm going to let you, Mr. Seller, live in the house for 1 to 3 months until you can buy a house and move in with the cash that I just gave you. Now you've become a lot more competitive.
Awesome. I love it.
Yeah, yeah.
So obviously the local market's been having a gangbusters year, and part of the driver obviously is the flow of home buyers, leaving downtown and not needing to be so close for work,
Yeah.
the work from home movement.
Yeah.
Do you see that this increase in prices as a temporary thing, or do you think it's like the price has been ratcheted up? So as whenever this is over, whatever that means, do you see people returning to the city and the demand outside of the city is far away?
Yeah, definitely. So you already do see a little bit of a reflux back to the city, and I don't think that will ever go away 100%. There will always need to be presence in the office. People are just more productive in an office. There's synergy, there's accountability, and there's just you need to be in an office. Now, that being said, make no mistake about it, COVID has shifted our mentality fundamentally about what we value and where we want to live, and it's definitely shifted to help put a premium on the suburbs and greater suburbs from Boston, for sure, and that's only increasing the lack of inventory. And so once again, all roads point back to there's just no more homes.
Yeah.
And we're just, the cost of materials still hasn't gone down yet, and yes, it will likely come down, and you will see, you're not going to see a fall off, my prediction, okay? This is just me. You're not ever going to see the 07-08 cliff. What you are going to see, in my opinion, is, although you haven't seen it this year, you've actually still seen a steady rise in the rate of appreciation, right? So the average house before COVID hit, okay, in the average market, and if you go back over 100 years, it's 3% year over year. But you have to remember, before COVID was a thing, we were in a very, very strong market right here that was already appreciating 8 or 9% per year, which was amazing. Now COVID's around and we're up in the teens. So what you're going to see is you're still going to see houses appreciate in the 13, 14% range. Over the next, I'd say 3 to 5 years, it'll get closer back to 10% year over year, but you're still going to see 10+% appreciation. And I don't think these houses are going anywhere. There's just not anywhere to go. We're on the coast. There's only so many slices of the pie on the ocean.
So do you see the local areas that you represent that there's still some value left?
Yeah, I mean, I think the only mistake people ever make is not buying a house when they think they should have. Okay. I think you mentioned there was a house that you wish you pulled the trigger on. And it's about perspective and education. And no, don't be willy-nilly, but it's a good investment in the long term. And I think one of your questions that you had asked me off camera is, are there any areas right now that are more valuable, that you're going to get more return for your money? And the reality is that the incoming tide raises all ships, right? Yeah. So what I mean by that is, yes, Newburyport is now pretty well saturated. It's hard to find a 4-bedroom, 3-bedroom in Newburyport for less than $700,000, okay? But that has now affected Amesbury, and it's affected Merrimack and West Newbury. And I mean, in my hometown of Lawrence, you're seeing houses go for $450,000, which you never thought you'd see. So the reality is that the way you're going to win is by looking at the neighborhood and making sure you don't have the nicest house on the block. And it's going to be all case specific, and it might not be a satisfactory answer, but I mean, we're seeing this across the board in Essex County, and New England, and I mean, I have friends in Missouri right now who are telling me they're in the same situation. It's just a lack of inventory, and you want to buy low and sell high.
Yeah. So let's have a little bit of fun with this last one.
Yep.
So a couple moving from Boston.
Yep.
2 kids.
Yep.
Can afford 20% down on a $1.5 million place. They've been approved.
Yep.
What town are you showing them first?
Yeah.
And why?
So, an interesting little insider tip here. So I'm high on Hines Way in Newburyport right now, and I'll tell you why. So there is townhouses that were built 2 years ago. Current market value is circa $750, and there is another dozen that are in the process of being built right now. They've just broken ground, and they're starting at $1 million.
Okay.
Same exact style, same exact complex. You're on a street that's 2 years old. It's better than brand new. It's 2 years old, and get in now and watch what happens to the value of your property over the next 2 months, 2 years. I'm sorry. I mean, you're going to be talking about a 20% return on interest, and mind you, this is a place where you could. It's a 3-bedroom house. You could easily charge $3,500 a month, which is going to net you $1,000 a month in profit if you only put down 10%.
Wow.
I think that's the no-brainer right now. If you can find a place to buy in Hines Way, that would be my insider tip.
All right, so now we're going to do a little bit of riff, unscripted questions.
Sure.
Like I said, my real estate journey was a 4-year journey. We moved here.
Yep.
South end of Newburyport.
Yep.
We bought a little postage stamp yard, which we thought was fine.
Yep.
We have 3 little boys. They're all
Sure.
getting bigger and bigger and bigger.
Yep.
We were at some open houses just yesterday.
I feel like this is a Mrs. Nelson question. Go
Yeah.
ahead.
So I came here and my wife planted some on me. So, basically we're at the point now where we're like our 5-year plan is now a 4-year plan because we're
Sure.
accelerating and thinking
Sure.
about this.
Yeah.
And
Which
you
is smart,
and you seem optimistic about the local market for the next 12
Yeah.
months. So basically FOMO, where we
Yeah.
went shopping, and
Yeah.
one of the ones we were a little bit interested in yesterday, under contract already.
Yeah.
Is this typical? I mean, like,
So let me
basically-
first of all interject a little bit. I tell all my buyers that the right time to buy is when you're ready. Okay? Like when your family is at a point where you really need more space. You need that yard. You need to provide a better life for your family, and you can't really live the life you need right now. Then it's time to move when your family is ready. So we like to posit that as like our first rule. And then our second rule is I would rather you be prepared and wait than need to all of a sudden you find your dream home and you have to rush to get ready.
Yeah.
So I'd rather you have a pre-approval and not need it than need a pre-approval and not have it. So I would say it's great to start a relationship with a lender that you trust as early as possible, so you know your financial reality. And I always coach my clients to start with the end in mind. What's your monthly payment going to be? Because when I'm no longer talking to you every Monday to check in on how you're doing, you're going to be left with that monthly payment. And I want to make sure that you're not cursing me for getting you into something you couldn't afford.
Yeah.
So think about that number, and then be ready. And that's the name of the game. And you just have to be ready, have a relationship with a lender, have a relationship with a realtor that you trust who's well connected within that demographic, because I think that next to quality of being verified as a buyer, the next most important thing is, do you have a relationship with a realtor that can instill trust in the listing agent?
Yeah.
That we're going to sell, your buyer's prepared, and you're going to close. So it's about a realtor that can convey and act quickly on your behalf and efficiently. So and then you're going to have to see a few go by. You're going to have to wrap your head around what 10% looks like. I coach people to build that into their home search. So if you know you're going to have to go $50,000 over, look $50,000 under your budget, and just know that that's the market value. So if you're looking at 5, start in the 450 range.
Yeah.
That's where you want to be, 450, and then you're competitive. And then you can come in and tell people that you want to take that house, please. Thank you.
So on the medium to higher price points, let's say on a $1 million house, single family.
Yep.
You're seeing an average 10% above asking?
Yeah, absolutely.
If it's priced right, assuming.
Yeah. I mean, I just sold one in Georgetown, 17% over. Wow. Sold in the 700s. Okay. It was listed in the 6s. But I mean, the same thing goes for $1 million homes. I mean, if it's a desirable property. Now, I will say, if it's a one-off, or it's got a funky layout, or if there's something wrong with it, it needs a major roof repair. I do think that there might be some good news for buyers in the sake of it's like the houses that need work are not selling as fast. A house that's going to generally be perceived as a hot house, like it's got all the basics and it's in good condition. Same rules apply for that hot house. If it's a raised ranch with, it needs updating in the, it's still mid-century modern, it might go a little bit slower than, something that was a little more family ready. But, so I think that's what I'm seeing in the market today.
That's awesome. I really do appreciate your time and your input on this, because
my pleasure.
I know Monday for Realtor, this is a day where you probably get hustling today. So I appreciate you taking time out of your schedule.
Absolutely.
Really appreciate your help, man. So
thanks for your time.
Thank you.
All right. Take care, guys. Good luck. Happy hunting.
I'd like to thank Mary, Matt, and you again. I know how valuable your time is and how much competition there is for your attention. So spending this time with me today, I don't take for granted. Hopefully you gained some knowledge and were maybe a little bit entertained. On the horizon, I'm planning on continuing this interview series. Next up is going to be talking to a college loan specialist. She's going to be helping us not just figure out what type of loans are preferential for taking out, how to best position yourself for those, but also once you're in repayment, some strategies about refinancing, loan forgiveness programs out there, and repayment strategies as well. And following that, we're going to be deep into employee benefit season. So we're going to be taking a look at the options you have and some things you should definitely consider before year end, whether it be HSAs, health insurance, if you're Medicare eligible, those types of plans as well, and some year end tax saving strategies. Coupled with that, we're going to be doing a Roth IRA master class before year end. We're going to be talking about different strategies to be able to not just save tax deferred, but maybe tax free, regardless of what your income is. There are ways that you can get some money into a tax free bucket. So please be sure to subscribe to my podcast, YouTube channel, newsletter. I'll be communicating upcoming dates through all those different channels. So hopefully you join us, and I'm excited to be on this journey with you. Now, some very important disclosures. I'm going to read these right to you so I don't miss anything. Securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. The opinions voiced in the material are for general information only and are not intended to provide specific advice or recommendations for any individual. Mary Gillach and Matthew Blanchette are not affiliated with Thriveable Strategies or LPL Financial. Investing in real estate involves risk. Forecasts set forth in this material may not develop as predicted. There's no guarantee that strategies promoted will be successful.